Every day, billions of dollars are generated and incinerated in a matter of seconds. Most people enter this environment expecting a wealth machine, yet they often trade without understanding the basic mechanics of the system. This lack of understanding creates a massive wealth gap. While some build generational fortunes, others lose everything because they can't define the asset they're putting their money into. To understand this, imagine splitting a small business, like a tea shop, into 100 identical parts. Each cart represents a stock. Buying one gives you a literal fractional ownership stake in the shop's equipment, inventory, and every dollar of profit it generates. In a neighborhood setting, that ownership is straightforward. But once those pieces enter the global market, they are traded at light speed in an environment entirely disconnected from the physical tea shop. If a stock is a piece of a real business, its value should be stable. Instead, these numbers flicker red and green every millisecond. To understand that volatility, we have to look at what actually moves the price. Many beginners assume a stock price rises because the underlying company is high quality or profitable. In the short term, that doesn't actually matter. Price movement is driven by supply and demand. Every trade requires a buyer and seller. When demand is overwhelming, the price is forced upward as buyers compete. But when panic hits, surplus supply causes the price to crash as sellers slash their asking price. The market functions as a cold mathematical friction between immediate bids and asks. In this environment, company health is secondary to the immediate balance of the scale. It's easy to assume the collective public, millions of retail investors, are the ones tipping that scale. But the data shows a different story. The real movement comes from institutions, major banks, hedge funds, and massive asset managers that control the vast majority of global capital. Because these entities control billions of dollars, their trades dictate the supply and demand curves. When they move, the entire market shifts in their direction. This leaves the individual investor at a structural disadvantage. They aren't the ones creating the trends. They are usually reacting to them, using information already priced in by the professionals. This delay often leads beginners into a trap. They buy into a stock only after it has generated massive public hype and the price has already peaked. When the institutional trend reverses and the price starts to slide, those same investors often panic and sell at a massive loss. The buy high, sell low cycle functions as a systemic transfer of capital. Amateur mistakes provide the necessary liquidity for professionals to execute their mathematical exits. Beneath the financial spreadsheets, the market functions as a live, heat-mapped topography of human psychology. This chart highlights how greed compels uninformed buyers to flood the market at the most dangerous point, the very top of a rally. Conversely, fear forces those same investors to capitulate and sell everything at the exact bottom of a crash, right before the market stabilizes. Professionals call this exit liquidity. When beginners rush to buy a surging stock, they are providing the cash institutions need to close their positions and walk away with a profit. Before making your next trade, stop looking at the hype. Start evaluating the underlying mechanics and ask yourself if you're entering a position early or simply paying for someone else's exit. The mechanics of the market are indifferent to your goals. If you sit down at this table and you can't spot the fool, it's you.